The P&C industry posted strong performance once again in 2014, with a return on equity of 9.6%, coming only slightly lower than last year's 11.4%, making it the second most profitable year since the 2008 financial crisis. Underwriting was profitable for the second year in a row, thanks to modest catastrophe losses, and premiums have continued to grow briskly. Interest rates remain low, but declining bond yields were partly offset by portfolio growth and gains on equities. Because of this great performance, the industry is very well capitalized heading into 2015, which is undoubtedly comforting for policyholders, but may present a headwind for profitability going forward. The industry's combined ratio was virtually unchanged from 2013, rising slightly from 95.7 to 96.5. Expenses remain in line with recent years, and losses in LAE had strong performance similar to 2013's. Once again, the distribution of premiums by line was very stable year over year as well, with the homeowners and private auto lines making up just over half the total. Personal lines premiums grew a little faster than commercial lines at 5.3% versus 3.5%. Though it's too early to say whether that's just normal fluctuation from year to year or not. Underwriting gains for the year totaled about $14 billion, down modestly from $17 billion in 2013, but still much better than the underwriting losses seen in 4 of the prior 5 years. 2014 was once again light on major earthquake, hurricane, or tornado events, and catastrophe losses remain low. Reserve developments were relatively minor in 2014 as well, with a modest increase in personal lines reserves offset by a decrease in commercial lines. Combined investment income was roughly flat in 2014, coming in at $66.4 billion versus $67.5 billion the year before. Realized gains were $7 billion lower than in 2013, as stock market returns were somewhat less exuberant, though still strong overall. This reduction in gains was mostly offset by an increase in investment income, seemingly driven by a decline in allocated investment expenses. Specifically, you can see on the graph how the net yield on investments actually rose slightly from 2013 to 2014, even though gross yields on all individual asset classes either fell or remained flat for the year. Interest rates remain close to historic lows, though volatility has increased as the Federal Reserve concluded their quantitative easing, or QE, bond buying program in late 2014, and speculation is now rampant about whether and when they'll begin normalizing rates, with mid to late 2015 a commonly cited estimate for their first rate increase. Although the P&C industry's average yield on bond investments declined from 3.74% to 3.56% in 2014, this was once again partly offset by strong equity market performance, with the benchmark S&P 500 index returning about 14% for the year. After multiple years of double-digit stock market returns, however, the industry's equity exposure now stands at a relatively high 38% of surplus, reflecting that these strong returns have brought with them increased risk. After growing rapidly almost every year since the financial crisis, surplus growth in the P&C industry slowed to 2.5% in 2014. This was in line with the rates of premium and asset growth, and so underwriting and financial leverage were flat for the year. Both remain at notably low levels given the large pool of surplus in the industry, which implies that P&C companies are well positioned to withstand any increases in losses in future years, but also that it will be more difficult to sustain recent levels of profitability given the smaller amounts of premium and investments earning income for every dollar of surplus. If the U.S. economy should finally manage to break out of its 2% GDP growth trend, however, the industry will have ample capacity to meet increased demands for insurance products. Furthermore, disruptive technological advancements in areas like ride-sharing networks, self-driving cars, personal and commercial use of drones, and unfortunately, cybercrime, all present potential avenues of growth for P&C insurers. And some companies have already started dipping a toe in providing coverages for these technologies and their users. The P&C industry once again posted healthy profits in 2014, though there are signs that growth is slowing, as it's hard to consistently increase premiums by 4 to 5% per year when the underlying economy is only growing at half that pace. Low losses and strong equity returns continue to support industry profitability, though there is risk that both of these effects could revert to the mean in coming years. P&C companies are very well capitalized on average, which will support future growth, but could weigh on earnings if that growth doesn't materialize. Looking ahead to 2015, key themes will include continuing technological development to support underwriting, actuarial, and ERM functions, the rise of new lines of business driven by developments in cybersecurity and consumer technology, fierce price competition across many traditional lines due to the slow growth economy and low recent loss experience, and the ongoing need for disciplined, customized investment solutions as the Fed's evolving policy stance leads to increased market volatility. Thank you for watching, and if you have any questions about P&C industry performance, or would like to see statistics for your own company portrayed relative to a custom peer group, please contact your portfolio management team if you're a current AAM client, or else contact the AAM Marketing and Business Development Department at 312-263-2900.